Well, welcome to today's edition. My name is Target. Kindly subscribe to our YouTube page and then share the link to all your contacts and your friends and then watch the video over and over and over. If in case you have any question, kindly put the questions in the comment box. I'll probably pick it and then respond to it. You can also forward all your questions to my email and then I'll respond to that. So check beneath it. You can see our email or find our email on the YouTube channel or Facebook or WhatsApp. I'll respond to it for you. Thank you. Now, today's edition, we are going to look at very straightforward and then basic intro of financial reporting. That's regulatory framework of financial reporting. So regulatory framework of financial reporting. Regulatory, right? Good. Framework of FR. Please, no shortcut in exams, so take note for me. Now, when you talk about regulatory framework of financial reporting, what do we mean? Or what is the meaning of that? For the regulatory framework, we are saying that what are the rules? What are the what? Is there any rules, laws, regulations? Mention them. Oh, yes. Let's make it regulations. Good. Is there any of these three items governing the preparation and presentation of financial statements? So that is the regulatory framework. Good. So then what is the need for it? Can anybody report on anything you want, or there's some sort of laws or rules govern the preparation so that companies won't report on what they feel like they have to report? No. Or when they feel like. So now let's just go straight to the sources of law for financial reporting in Ghana. Good. Or in your country too as well. So sources of law. Good. So that's source of law / regulation. Sources of law / regulation of financial reporting in what? In Ghana. Good. So if you are in UK, just put UK there. If you are in US, just put US there, and then you are fine. If you want probably South Africa, just put South Africa there and you're fine. So currently I'm in Ghana, so I have to put Ghana there, of your country. Now let's just talk about the source of law for financial reporting in Ghana. Now be with me. So in Ghana, what are the laws that guide the preparation and presentation of financial statements? So to begin with, or the very first one on the list is the one that normally come to mind first. That, okay, the law, the Companies what? Code or the Companies Act. So the Companies Act 2019, Act what? Oh yes, got it for me. 992. That's the new act recently passed in 2019, 1st August, signed by the President Nadu. Good. So that is it. So it gives some sort of rules regulation how the account should be prepared. For instance, the 4th and 7th schedule of the act states that at least companies should prepare accounts annually or at least once a year. At least what? Once a year. Some level of regulation or some rules. And then if you are a fresh company, you have up to what? 18 months. Up to 18 months. All these ones are forms of what? Rules or regulations plated in the act. So please kindly get it and read the 4th and what? The 7th schedule for me. Kindly do that. Kindly do that. Okay, so that is it. The next one that I'll talk about, it is the Ghana Stock Exchange. Ghana Stock Exchange or stock market. Good. Ghana Stock Exchange. That's the listing rules, listing requirement This also give us some sort of what regulation rules that guides the preparation of account. For instance, if we're a listed company in Ghana and you open your account, there should be some stock market index in your account, where unlisted company don't need to provide that. For instance, EPS, yes, DPS, that's the earnings per share, dividend per share, and then the other stock market index should be there, should be quoted. And then your market price will also be stated for you. Thank you. So these are the source. And then the third one I'll talk about it is probably Africa Union or European Union, the union that your country belongs to. This also give us some sort of what directives. So directives or instructions. Oh yes. Now we are going to report on that. Show this, declare this. It may be stated by the union, so they can also serve us. Then the fourth one is what? The conceptual framework. Conceptual framework. Good news, we've done it. That's our first topic in financial reporting. So if you have not watched that video, kindly pause, go and watch it before coming and continue, because it's a chain. Fifth one is the IFRSs. IFRSs. So these are the sources of what? Law or rules or regulation in Ghana currently. So that is it. Please, the Banking Act, how do you call it? The Banking Act, Bank of Ghana's Act, please, they are not the sources of law for financial reporting. You need the Banking Act or the Bank of Ghana's Act if or not if you are what? A bank. What if I'm a manufacturer? Do I need the Banking Act? No, I don't need the Banking Act. But whether you're a manufacturer, you are a bank, you are a sole trader, whoever you have to abide by this requirement. I hope you get it. So whether you are a manufacturer, you are a bank, you are an insurance company, you have to obey all this. Yes, because insurance companies, you are registered under the Companies Act because you are a company. Good. Just that your object is what? You are into what? Insurance. Take note. Company. So that is it. Good. Now this, I've given an example that you go and read fourth and seventh schedule, stock exchange. I have in the notes, so probably get the notes and then get the listing requirements. AU directives, no. Concession framework, you've done with it. Okay, so the only one that you're not going to do is what? The IFRS, because you've not done that one. And thank you. So now you're going to do IFRSs. In fact, the main issue with the regulatory framework is with the IFRSs. But I decided to walk you through all this for you to appreciate the regulatory framework well. Now let's go and do the IFRSs. But before that, let me ask this question. Kindly tell me, why do you think there should be a need for regulation? Why? Why there should be a need for regulation? Why can't we allow them? They have their money, they are set up their company. Why should you worry them and enforce them and make sure that they report on this, on that, each and every day consistently? Why? Tell me. Why? Okay, come again. Yes, I'll take that. Now, the main reason is to probably to prove sanity or to provide some sanity in reporting. Other than that, anybody just put something together to represent something. Yes, so when the sanity is being provided, to protect the interests of the investors. So to what? Protect. So to protect the interests of what? The investors. Oh yes, investors or owners and other users. Oh yes, because if I've invested funds in a South Africa company, which is in South Africa, and then you are here, if there's no law that guides their preparation and presentation of financial statements, you'll be wondering, is my fund saved there, or they are misusing it, or it's not about the account that they are preparing though. If there's no law guiding them, they can prepare anything funny. Put some figures together, print it, forward it to you with your email. You read it. Okay, I'm good. Oh. Within six months or 6 years, no funds will hit your account, but still there will be some sort of information given to you. But that information has not been authenticated, or there's no law guiding them, so they can just present anything that they want. Good. So that is it. So that's the main aim. Now let's go to the IFRSs, how the IFRSs is being formed, and who even formed the IFRSs, because that's the main aim. But the the regulatory framework mainly talks about the IFRSs. So now let's go into detail what the IFRSs is, what it's about. Some are called IESs, what it's about. So by the end of this lecture, you'll be okay with all. So thank you for being with me once again. Now, the IFRS, that's the International Financial Reporting Standards. Who set it? How was the structure of the certain body? This is the structure of the certain body. Now, there was a big guys. I call them big guys. Oh yes, because they are the boss. Call them IFRS what? IFRS Foundation. IFRS Foundation. So it means that they are the foundation. So that's why I call it the big boss. Oh yes. In fact, they're supposed to set the standard themselves. Oh yes. They're supposed to do the standards. They're supposed to bring out the standards themselves. But they have appointed a board to prepare and issue the standard on their behalf. So therefore, appointed a board. They have appointed a board. So that's IASB. So that's the board. International Accounting Standard Board. Formerly, it was a council. So I'll explain that's why it was a council formerly. So, in fact, the board has what? Oh, yes, you see that, right? Okay, yes. So they have what? Appoint. They have fund. They have what? Govern. They've governed. What again? Oh, yes, I like that. They oversee. Meaning you are using the note term. They oversee the activities of what? Of the board. They have oversee the activities of the board. So that is it. So these are the functions of the IFRS Foundation. They have 4 solid functions. They appoint members onto the board. They have to fund the board. They have to govern the board. And they have to oversee the activities of the board. Now tell me the sole objective of the board. For the board, they have only one objective. Is that to prepare and issue what? IFRSs. To prepare and issue IFRSs. That's the standard. Don't forget that they are the one that brought the conceptual framework, and they are the one that issues what? The IFRSs. I like that you are following. Thank you. Then they have another one called Advisory Council. What do you think will be their objective, the Advisory Council? The Advisory Council, the objective probably is to what? Probably advise the board. Oh yes. They provide what? Advisory service to the board. The board. Oh yes, you see that. And then everything is like this top here and then the other side, right, and then down. So that is it. Okay, so we will talk about the interpretation committee. So interpretation committee 2 is here. Also formed by what? The diagram does not look like so. It well. Put it so interpretation committee. Good. So interpretation committee. They also what? Interpret or enforce the IFRSs issued by what? The board. So you can see. So this is the structure of what? Of the standard setting body. So that is it. Now, what are the functions of the ISB? The main function or the sole function is what? Prepare and issue the IFRSs. They have ownership over it. Then, if someone appoints you, fund you, govern you, oversee you, then what do you have to do to that person? Oh yes, you have to report back to the person. Of course, so they report back to the person. So report, they write a report him on how standards are doing, and then the level of risks facing their standard publishing. So that is it. Good. Now let me explain this. All of them, they have a common objective. In fact, the objective of the IFRS foundation is the same as the objective of what? The board. Because the foundation, the boss, they have to prepare and issue the IFRS, but they have appointed someone. So purposely or specifically, their objectives are the same, but the role that they perform are different. So this one, they have a 4 functions. This one also have a sole function to issue the IFRS. So their functions are the ones that I've illustrated here. So this guy will advise, advisory service. This guy will do what? Will explain, explanatory note, have explanatory note, and then enforceability of what? The IFRSs, enforceability and explanatory note of the IFRSs. How we get that? Good, you are fine. Now that you know their functions, now what are their objectives? In fact, the board and then the IFRS foundation have a common objective. The objectives are, I'll give you 3. Please add 2 to it, making 5. I'll short it for you. Objective number 1. Objective number 1. So objective of what? The let me write it at the top there, because there's some 9 space at the top. Yeah. So objectives of the ISB or the IFRS foundation. Objective number 1 is to develop high quality, globally acceptable accounting standards. So high quality, globally acceptable financial reporting standards or accounting standards. How we get that? So to develop what? High quality, globally acceptable accounting standards. So to develop, in short, to develop what? IFRS. Okay. Then 2, after they develop this high quality, globally acceptable financial reporting standard, they should not put it under their pillow and every day they should be sleeping on it. No, they have to promote the use of it, encourage countries, member states, institutions, corporations, companies to what? Adopt and use it. So the objective is what? To promote the use of what? The standards, financial reporting standards. So let's make it IFRS. Good, the IFRS. Then I'll give my last point. That's the 3rd point. That's the 3rd objective. The 3rd objective is to what? 3rd objective is to limit the alternative transactions, alternative treatment of accounting transactions. So to limit what? The alternative treatment of accounting transactions. So for instance, if I give you just a transaction I call 100 accountants, this accountant will give me different treatments. So I'll get 100 different treatments, which does not improve comparability or standardization. So to do that, one of the objectives of the IFRS is to limit the alternative treatment that everybody have. No, please, this is the acceptable way. Follow it and then be safe and be free. That's all. So to what? Limit the alternative treatment. Limit what? Alternative treatment of what? Accounting transaction. Good. Now I am done. Now we should also know the individual objective of the Advisory Council and Interpretation Committee, and then you'll be fine. All of them are stipulated in the books. Good. Now let's move on to the key aspect, what you need to pass your exams, then you are fine. Okay. Now you've realized that the standards, some are IAS and some are IFRS. And then it's creating confusion, right? Don't worry, we clear that one. Some are IAS, and some are what? IFRS. Okay, good. Let me do that one also here. Some are IFRS and some are IAS. So what's the difference and what account for that? Now let me start from the genesis of the standards. Now in 1966, a group of professional accountants or experienced accounting bodies like the IFAC, the sub-unit of IFAC, they started and said, okay, can you bring some standardization and reporting? Can you bring some concepts, some rules that will guide the preparation and presentation of financial statement. A body of what? IFAC. A body of IFAC. That's the International Federation of what? Accountants. Now, that body sat down. I'll name the body. They sat down and said, okay, let's provide some sort of what? Some sort of standardization or some sort of rules that will guide the preparation, or the rules that they will deal with specific issues. Okay, then that's good. Then they call it what? They name themselves International Accounting Standard Council. So that's why formally one was called Council. So it was called International Accounting Standard Council. So that was the name of the body that started the standards. So 66, they didn't issue any standard until 73, where they started issue the standard. So if you can bear with me, then we can say that what? The incubation period of the standard is what? From 66 to what? 73. Oh yes, that's the incubation what? Period. Good. No exam now asks you all this, but you know it to help you to understand the standard very well. Good. So in 73 up to 2001, they issued 41 standards, and they were named IAS, International Accounting Standard Council. International Accounting Standards, not council. The name of the body is the council. So the standard issue is called the IAS. The IAS. They have 1 up to what? 41. So from where? 73 up to 2001, 1973 up to 2001. So that's where they issued the 41. They did well. Oh yes, they did well. They were able to issue a 41 standard within how many years? Good. They did very well, extremely well, extremely well. So I really like their. Oh yes, within 28 years, 28 to 29, 41 standards. So meaning on average, 41 divided by 28, what to be? So does it mean that 1.4 standard each year? Okay, so probably that's it. Okay, now, so something happened in April 2001. April 2001. So those days, this was called committee, and this was advisory committee. This was IAS what? Foundation. IAS Foundation, not IFRS Foundation. So it was IAS Foundation. Okay, that is it. But why did you call this one IFRS Board? So let it there. Good. Now let's move on. So in April 2001 to date, so from 2001 to what date or to date that you come with the IFRSs, or in short, in April 2001, something happened. They realized that some of the standards that they've issued in 73, between 73 and 2001, they are no longer applied. Their requirements are out of date. So what they have to do, they have to probably amend it. So they decided to amend the standards that are out of date. So how do they go by it? Now they have to update the existing one and they have to bring new ones. So the new standard that they are going to issue, they should bear it a name, or they should probably call it what? IFRS. International Financial Reporting Standard, instead of the International Accounting Standard. So they feel like the financial reporting FR is more of like have more weight than accounting. So they should call it IFRS. So the IFRS in simple quotes are the standard that issued after what? 2001 to today. They are there to replace the old standards, or some of them to are there on their own. So how we get that? So then they do some major overhaul, and then they call the IAS Council as what? They call the foundation, the International Accounting Standard Foundation, as what? IFRS Foundation. And then they call the International Accounting Standard Council as what? As board. They change the committee here to council, and then now we have this structure. So this is a brief history or genesis about the IFRS. Good. So that is it. So that's why the IAS, the current IAS that we have, they are not in number. So if you check the IAS, the International Accounting Standard, we have 1, we have 2, we don't have 3, we don't have 4, we don't have 5, we don't have 6, but we have 7, We have 8. We don't have 9. We have 10. 11 was cancelled last 2 years, so we have 12. Then 13, we have 13. No, 13 has been cancelled. Then we have what? 14 cancelled. 15 cancelled. 16, yes, we have 16. That's the PPE, almighty PPE. Good. 17 cancelled last 2 years. That's the leases. 18 cancelled revenue. That's last 2 years. Then we have 20 grants. Then we have 21. It's still there. Foreign exchange transactions. Then 22 cancelled. 23. Oh yes, it's there. Borrowing costs. 24 related party transactions. 25 cancelled. 26 cancelled. 27 separate financial statements. So it's there. 27 separate financial statements. 28 cancelled. 29 cancelled. 30 cancelled. 31 cancelled. 32 is there. So these are the standard I'm listing for you. The one that you need for your exams. 32 is there. That's financial instruments. That's the recognition of financial instruments. Then we have 33 earnings per share. 34 cancel. 35 cancel. 36 impairments. 37 provisions, liability, contingent assets and contingent liabilities. So that is it. 38 intangible assets. 39 financial instruments. So this and this talks about financial instruments plus IFRS 7 and 9. All of this talks about financial instruments. So first standard talking about financial instrument now. So take notes. Okay. Then we have 40 is there. That's investment property. Then IS 41 biological assets. So these are the current one. Very soon all these standards will leave the system. They will go and then we'll be replaced by the IFRS. So that probably 50 to 100 years of us, then all the standard will be later, so that the new generation, when they come and then read our history that, okay, now this IFRS, formerly it was IAS, so you are seeing it. The time will come, will no longer be there. So that is it. Now let's look at the IFRS. IFRS, they are in number. So after 2001, they're able to issue 16. So IFRSs, they are in number. So you have 1 up to what? 16. Now 17, they are done. They are done with 17. Very soon they'll publish it and then the companies will have to adopt it. That's a construction contract. Oh, sorry, that's the insurance contract. Talked about insurance. So that is it. Now, for the purpose of your studies, not all of them are applicable to your examination. So note the one that are applicable. Probably the CAs, I will probably come out with it for the subsequent lectures when I start with the standards. So take note. For the CA, level 2, you need 17 standard. Level 3, you need maximum of 24 standards, or the 21 standard for the level 3. So if you're writing ICA level 2, please note that you need 17 of the standards, both the IAS and IFRSs. Level 3 you need 24 of the standards, both IAS and IFRSs. So that's it. Thank you. But if you're writing ACIB, they need maximum. So maximum of 10 standards, you're okay. 10 to 12 standards, you are okay. So that is it. Good. Now that you know the IFRSs and the IAS, can you probably talk about advantages of international harmonization? Advantages of what? International harmonization. No shortcut in the exams. So what are the importance, or what will be the uses, or what will be the benefits if this IFRS is being harmonized all over the world? Meaning every country, every company, every institution is using the IFRS to prepare each account, each set of accounts. So what do you think will be the importance of it? Oh yes, even now, what will be the importance? We have the general important, we have the specific. So probably to a multinational company, to what? A multinational company. Multinational company. So to a multinational, what do you think will be the importance? Important number 1, it will improve what? Comparability. Improve what? Comparability. Improve comparability. Good. Because there will be some level of standardization. So uniformity. Financial statement prepared in Ghana will be the same as that of what? Togo. That of what? South Africa so that you can compare the performance, because the IFRS or the accounting rules used in preparation and presentation are basically the same. So that is it. But again, okay, I like that. It will reduce what? Audit costs. So reduction of audit cost. Reduce audit what? Audit cost. Audit cost. Oh yes, because if you use the IFRS to prepare the account, it means that when the auditors come around, they will spend lesser time to audit it because it's standard everywhere and then they are aware of it. Yeah, so if you don't use the IFRS, when they come, they have to now, one, learn what they are using to convert it to the international standard before they can audit your financial statement. That will take longer. And then the longer the time that they spend during the audit work, the larger or the expensive the audit cost will be. So that is it. So to use the audit cost because they spend lesser time there. 3, transfer of staff. Transfer of what? Staff. Transfer of staff. It means that an accountant in Ghana can also be what? Accountant in what? UK. Can also be accountant in South Africa. Why? Because the basis of the reportings are the same, and then the rules of the IFRS are the same in the country. So that's it. Or this one normally happens between the audit firms. If you can check the audit firm well, you normally transfer their partners. So partner in Ghana will be transferred to that of Nigeria, South Africa. Why? Because the standards are the same. If there is a different basis, a different rule, they find it difficult. So they have to provide some level of training before the staff can be moved to different generation. So that's it. Now what about the 4th point? Easy access. Easy access of what? Finance. So easy access of finance. Easy access of finance. Easy access of finance. Easy access of what? Finance. You get access to finance easily. Oh yes, because if you're going for loans or advance from international countries or going from international institutions, worldwide institutions, the more probably require the IFRS or to give you or to serve as what added advantage or opportunity for you to grab any international opportunity. Oh yes, because if you know IFRS, if you use IFRS to prepare your account and you're going to probably pick a loan from IMF, they'll probably require you to probably prepare the account using IFRS before they can give you the loan. Oh yes, so that is it. Now I'll give you a work for Ghana. Ghana adopted the IFRS in January 1st, 2007. Oh yes, January what? 1st, 2007. January 1st, January 2007. That's where Ghana, we adopted the IFRS. Now, your assignment is that go and look for the reason why Ghana adopted the IFRS. Before that, Ghana was using what? Ghana was using the Ghana Gap. So until 1st January 2007, we changed it to what? IFRS. This, I'm not saying that Ghana was going for loan and then the loan financiers forced us to come and then adopt the IFRS before they give us the loan. I'm asking you to probably go and then check. Thank you. Okay. Now the 5th point that probably we talk about it is easy expansion. You can expand quickly. Oh yes. Expand once you can access finance easily, then it can also lead to expansion because when they expand to the next territory, the reporting is the same, so there will not be any difficulty. So expansion. So expansion opportunities. So expansion opportunities. Okay, so that's it. So you expand easily. So that is it. So take notes. Now let's move on to the next one. Good. So that is it. Now let's move on to the next on the list. Okay, so I'll talk about in fact the same point I've written there. Don't mind, Fred. Apart from expansion, what's the next one that we will talk about? We can also talk about oh yes, I like your points. I like your points. Yes, I like your points. Last, to the tax authority to help them probably to calculate the tax liability. To help the tax authority to calculate the tax liability. So helps the tax authority to what? To calculate the tax liability of that multinational. Okay, so that is it. Okay, you can also extend it to 10 for me. Yes, extend a point for me so that you'll be fine. Now let's move on to the next topic that talks about the barrier to international harmonization. Barrier to international harmonization. Yeah, the advantages of the international harmonization. Please, they can also ask you question specific. Oh yes, like what happened in 2017, ICA papers, both May and November. They were asked for what? Country specific. So what will be the benefit Ghana has derived since the adoption of what? The IFRS. This is specific. Okay, to help Ghana to compare its financial performance in the performance of the country, sorry, performance of the companies in the country. Performance of what? The companies in the country can be compared to that of what? Other country. That's the objective or the importance. So here, that one is a country specific. So take note for me and then you'll be fine. Okay. Okay, so now let's move on to the disadvantage or the barriers of international harmonization. We call it barriers. Barriers to what? International harmonization. So barriers to international harmonization. Now, these are some level of difficulties that we have, or difficulties that, or challenges, or obstacles that prevent country from what? Accepting the IFRSs. So that is it. So obstacles or difficulties that the countries normally face when they want to adopt the IFRS. The very first one that we talk about is the different legal system. Different legal system. So consider the legal system of the countries that we have on this earth. They are different. Check Ghana, our legal system. Check that of UK. Check that of South Africa. Check that of Nigeria. They are quite different. So one set of rules cannot cope with all this legal system. So if a country is there and then its legal system, the national laws conflict with the IFRS, that country will decide, will not be willing to accept the IFRS because they will end up losing their sovereignty. Like their national law will be thrown away and then the foreign law will come and then have dominance on them. So that is it. Now, currently, Ghana, our company's code conflict with the IFRS 10. Oh yes, the consolidation is conflict. Just that whatever the company's code said, the national law states. National law have upper hand over what? The international financial reporting standard, the IFRS. So that's it. 2, cultural differences. Oh yes, cultural differences. Cultural differences. Check the way of life of the country specific. The countries that we have, they are so different cultures. How can one set of law bind or covers all of them? Or even, in fact, if one country realizes that their national culture or their culture conflict with your IFRS or conflict with your culture, and you're the one that said the standard, they will not even adopt the standard. Oh yes, but their culture conflict with your culture. So that is their culture crash. Now look at the way Indians have their culture or the way they behave towards certain transactions. It will have influence in their financial report. Oh yes, how you live, how you stay, how your culture is will automatically have some level of influence in your financial reporting. Oh yes, despite that you're going to record figure, but how you behave will tell you what figure you record. Oh yes, so that is it. Good. Now take Chinese for instance. Nothing will prevent Chinese man from eating with what? Their sticks. They make the expensive and the durable and the nicer spoon, but yet still they eat with your what? Their spoons. Nothing will prevent them. Oh yes, so that is it. So if you are bringing culture that will let them eat with spoons or with their hands, no. Throwing their sticks away, they will not accept it. So that is the cultural differences. Now the third point that I'll probably talk about it will be need of financial reporting. Need of what? Financial reporting. Some country, if you only prepare financial statement, or you only report when you owe the government, or when you're going to pay tax. So the need of financial reporting are different. So different needs of financial reporting. So the needs of financial reporting are different. So the needs are what? Different. So they are different, country to country. Some country, you only prepare account if you're going to pay tax. Oh yes, you're going to pay tax. Bring the set of accounts so that they can confirm your tax liability for you. In some country, only when you owe the state. Yes, only when you owe the state. And some country, only when you're going to collapse. And then other country, most country, only when you are a company, you have to prepare the account. When you're a company, not sole trader, not partnership. So that is it. Then the fourth one is the need of developing country. So need of what? Developing country. Now what we are saying that developing country does not need what? Need IFRS, because they can't cook it and eat. Now tell me, if you are hungry, oh yes, you are extremely hungry. You are extremely what? Hungry. We get time to go and prepare financial statement or go and report the country, the developing countries. Their basic needs are not there. Food, road, shelter, clothing, security are not there. We get time to go and report on comfort zone? No. So the need of the developing country is not the IFRS, because the IFRS cannot solve the hunger issue. IFRS cannot solve the poor road. IFRS cannot solve the poor infrastructure. The IFRS cannot solve the poverty and then the unemployment rate in a country. So if we're a developing country and you are seriously, your mind, all your concentrations on how to get all these economic indicators done, will you get time and go and accept the IFRS? No. Even the cost of training, you have to train the people, the citizens, to be aware of the IFRS. That training cost can even construct maybe a kilometer of road. That's economical than the IFRS, because after when they come, they cannot put the IFRS. They cannot probably convert it into food and then probably eat it. So the need of the developing countries is not the IFRS. So to deter the developing countries from adopting it. Oh yes. That's why Liberia have not accepted the IFRS. Oh yes. Liberia have not accepted the IFRS. Yes. So that is it. Now, our fifth point will be lack of what? Strong accountancy body. Accountancy what? Body. So if there's a country where they don't have a strong accountancy body to enforce these IFRSs, they will not adopt it too, because they know they are people. If you go and bring it and there's no one to enforce it, they will just provide remix. Oh yes, they provide remix, and then they provide their own interpretation, their own meaning to it, and then they will now provide different requirements. So such a country will not go in for it. Yes, any country that does not have a strong accountancy body. And thank God, Ghana, we have ICA. So ICA will supervise or enforce the IFRSs in the country. So thank you. Now the sixth one I'll talk about it is nationalism. Oh yes, it's a very challenging one globally. So it's a globally issue, a global issue. So nationalism. One country is not ready to accept the other country's item. Oh yes, countries. This country and this country, they are not in good terms, right? So whatever this country produce does not enter my country, I'll never accept it. Even if you enter, you should pack to the back door. So currently, US have not accepted what? The IFRS. Why? Because they are saying that the US gap is much, far better than what? The IFRS. And moreover, the IFRS is made from what? UK. And UK too, the IFAC too is saying that IFAC is not a governmental organization. It's a non-governmental. It's not a country-based, though it's based in what? UK or Britain. But it's not solely a government owned. No country owns it. It's made up of the members, or the owners are members of the countries. Yes, the countries that form the members. of the IFAC or the ISB. So it's not like one country owing it. Still, US have not adopted the IFRS. Now I don't know what they are doing. Now they've sent a team of professionals to analyze the US GAAP and then find the differences between the US GAAP and then the IFRS. So what they do is that they will delete these differences between the IFRS and the US GAAP. They will delete it, and then after they delete it, automatically the IFRS and US GAAP will be the same. Now I'll give you work. Please go and look for the difference between the US GAAP and the IFRS. What the differences? So the differences, they're about 5 in number. I'll probably give you like 2 or 3. Try and go look for the other one too, and then you'll be fine. The very first one I'll give it to is the IS2, the inventory. Now, know that inventory with the IFRS, with the IS2, we don't use LIFO. IS2, we ban LIFO. But with the US GAAP, LIFO, you have to choose between LIFO and FIFO. So LIFO is allowed in the US GAAP. Okay, so take note. And then the other example that I'll give it to you, probably as it. So the next one I'll give you will be the consolidation. Oh yes, IFRS's consolidation is based on control, but with the US GAAP, consolidation is based on the risks and reward. These are the difference between the US GAAP and an IFRS. Then I also talks about IAS 38. There's also a difference there. That's intangible asset development cost. With the IFRS, with the development cost, we capitalize development costs based on certain what condition. If the conditions are there, we capitalize development cost. Development what cost? We capitalize it in IFRS. When you go to US GAAP, development cost should be expense totally. So you expense it. And then the final one I'll give it to you. The IFRS is based on what? Principle-based approach. And then the US GAAP is based on the rule-based. So these are the differences between the IFRS and then this one. Okay, so I'll list the following countries, about 3 of them for you. They don't use IFRS in their public company. Example is Egypt. So Egypt, the foreign countries does not permit their listed companies to use IFRS. Oh yes. Egypt is one, US is one, then Moldova, that's the Liberian. Liberian also does not also use the IFRS. And then many more. In fact, about 113 countries now use IFRS. Very soon we'll push forward that all of them will use the IFRS. Okay, so that is it. Thank you. Now let's move on to the barriers. Now I'll talk about costs of training and retraining. So cost of training and retraining. Let's assume that you have assessed the amount of money that you're going to spend to train your professors, and then the various universities, workshop, conferences, for them to be aware and for them to be known to the IFRS so that they can also impart it to the students. If you consider the cost involved, and that cost is huge, and you don't have food to eat, and unemployment is high, poor roads, can't use that money to develop the country. So the cost of training and retraining can also deter some organization. Oh yes. The advanced countries, for them the basic need is there. So they don't think of the basic needs. It's there. So what they need is secondary. And now for developing country, I repeat, for developing country, they don't need a secondary issue. They do not develop the secondary because you move from class 1 to class 2. You don't jump to class 2. So for all developing countries, including especially the African countries, you have to make sure that we have to develop our primary needs well. Our basic needs are there before we move on. Other than that, we will step and then now we go there. Yes, we have the second, we have the IFRS, but still we are not developing. Still, the infrastructures are not there. Still, the roads are poor. Still, unemployment rates are going high. Still, poverty is overwhelming the country. So that is it. It's because the primary sector has been ignored, or the basic sector has been ignored. So that is it. Good. I also talks about unique transactions. Unique transactions. Yes, their standards may be limited to what? May be limited to unique transactions. the IFRS may be limited to unique transactions. Now we are in COVID-19 pandemic. Is there any standard IFRS specific that stated that COVID-19, when it comes, we should do this and do that? Even we are even thinking how to treat the COVID-19 losses, whether to be event after reporting period, whether to be adjusting or non-adjusting. So that is it. So unique transactions, the limitations, the IFRS may serve as a barrier. Okay. Now let's move on to my last topic of the day, and then you are fine. The last topic of the day. Please don't forget to subscribe, share the link of the YouTube channel to your friends, family, and loved ones. At least give them with a video, and then they will bless and thank you. Don't forget, if you have any question, kindly post the question on the comment box or forward the question to our email. We are going to respond to it. We are a team of professionals. We will respond to it quickly for you. Now, the last topic that I'll do is the standard setting process. Standard setting process. And that's the last topic of the day. Good. Standard setting process. Now, the standard setting process usually talks about what are the steps or the process that the board, the ISB board, that's the International Accounting Standard Board, normally goes through to come out with the standard. Please, with the process, we don't have for new standards or for updates, whether they are updating or they are coming out the new or future standard. All of them go through the same process. So take note. Whether the question trick you and say that, okay, what is the standard for certain? What's the standard for updating? Sorry, what's the process for updating standards? Don't go and say, oh, what I was given is the standard setting process. So that one is the new standard, not the update. It's the same. So take note. First process is what? Agenda. Agenda consultation and plan of work. Plan of work. What do we mean by this? It means that before we can come out with a standard, new, whether new or update, existing one, we have to what? Consult for agenda, consult for idea. So how did you consult? The IASB will consult for idea from two sort of people, internally and external. Now, internally, they will consult from the advisory council. So probably they will schedule a meeting with the advisory council and tell them that, for example, hello guys, we want to issue a standard called IFRS 19, accounting treatment of pandemic losses. Example, COVID-19. So that's the IFRS, or that's the standard. So hello guys, give us your idea, your opinion, how we should go by it. Okay, then advisory council also said that, okay, normally in pandemic, losses are incurred daily and huge. And then sad, people are loss of lives and all other issues. So please make sure that you key in from this, from that to that point. So like a form of advice or the idea. Then normally the board also sends some documents to the member state or anybody that use for the IFRSs or anybody that adopted the IFRSs. They will give you a document annually. And now they will tell you to now comment or come out with some issues that you have or any challenge that you have with the standard that you are applying or the standard you are using currently. So if you have any issue with any of the standard, you quickly put it down and then forward it to them. And then any comment that you want them to probably consider. So that's the external. So for the external, the comments received from the general public annually, that's what they will go through. So all these are ideas so that they can now have a broader or a wider base of ideas. So when they bring the standard, yes, it will cover all aspects. Not that only few people go and corner somewhere, put some certain things together to represent something. No, not at all. Yes, you have to put all this into consideration. Good. Now, after the idea has been what? Gathered, they have to plan the work. So that's the agenda consultation and plan of work. So they will plan the work. Okay, let's start from here. Let's start from the definition of pandemic. Let's define pandemic. Pandemic is not when there's a road accident and 5 people die. That's not pandemic. Pandemic is not when your country is not doing well. That's not pandemic. Let's define pandemic. Pandemic is a public outbreak of disease or some natural disaster which occur worldwide. Every country, almost every country, or majority of the country is facing. So they'll define it for you. Okay, so from there, where do we go? Then what is the recognition? How do you treat the losses? Subsequent year, and then the initial year. So today, how do you treat the loss? Thereafter, how do you treat the loss? And then that's it. So that's the plan of work. So following the plan of work, then there'll be what we call discussion paper. Discussion what? Paper. Now with the discussion paper, that one is like, I call it the skeleton version of the standard, the skeleton. So after they plan the work, now they put the plan of work into probably a note form or a written form. Yes, and call it discussion paper. Yeah, they may, it's not compulsory. They may send it to the general public for comment. Oh yeah, they can send the general public for comment because it's not compulsory because it's the introduction stage. Yes, so that is it. Already have included your inputs because it's mostly expensive. Oh yes, it's mostly expensive to do that. Friend discussion paper, send it to all the member states or countries. So that is it. Now, after the discussion paper, probably if they send it to the general public for comment, following the comment received, they will now add the flesh to it. Okay, let's add the flesh to the skeleton. So that will be what? The exposure draft. Exposure or draft. Exposure draft. So now prepare exposure draft. And this exposure draft, it is the draft version of the financial report, of the standard. The financial reporting standard, the draft version of the financial reporting standard. So that is it. And here, it's a must, mandatory. The board have to forward it to the general public for comment. Oh yes, because if care is not taken, you probably adopt what you don't like. They put something together to present something. So please be aware of this, what you are bringing, so that next time, don't go and stand somewhere and blame us that our standard is 40, it's lacking this, lacking that. Please get it. This is what you are going to bring. So if you have any issue, please bring it now so we can take into consideration. How we get it? Good. So that's the exposure draft. Now, following the comment received, then you have to do what we call revision of the exposure draft. Revision of what? Exposure draft. Revision of exposure draft. Exposure draft. Good. Probably if the comment is not not to the same place or not to the same idea, or there's some opposing comments, you have to revise the exposure draft until the final one has been what? Accepted. So if the final draft has been accepted, what do you think will be the next step? Oh yes, the final one. Okay, so the final will be what? New IFRS is born, right? New baby will be given birth to. So new IFRS will be issued. Will be what? Issued. Or new IFRS is issued. What do you think when they issue it? What do you think will happen? Okay, people have to adopt it too. So adoption of the IFRS. The adoption will continue. What do you think after adoption? So after adoption, post-implementation review. Post what? Implementation review. Implementation review. Here, two things will happen here. Post-implementation review, two things will happen. That's the last stage. Here, the interpretation committee have to go around and make sure that the requirements in the IFRS are the one that the companies using or the one that companies applying. They're not applying their own understanding. So if they are applying their own understanding, probably it may do that they don't understand the requirement in the IFRS. So what do you do? So they have to now hold seminars, conferences, workshop, training to train the people or the companies or the CFO or the consultants the requirement of the IFRS and probably explain or give us some level of what explanatory note to the IFRS, and that is it. Okay, good. So now I'm done with the regulatory framework of the financial reporting. So my next topic will be the standards. I'm starting the standards. So kindly wait for or search for the next standard. That's the IFRS. IAS2 inventory. So in the subsequent lecture or next lecture, please look out for the IAS2, the inventory. That's what we're going to talk about it, so that you'll be into it right from there. From the standard, then I'll move on to the issues, the reporting itself, so that you'll be fine. Now that we know the regulatory, the rules guiding the preparation, and we know the concept, the principles, we can now start the rules one after the other. Please, the IFRS provide what a specific laws, a specific requirement. So take note from me, then you'll be fine. Good. Thank you for watching, and then don't forget to subscribe to the page and then share the link to your friends to that maybe use or maybe help the other contents. If you have any question, kindly put it on the suggestion box, and then you can also follow us on Facebook. The same name, Facebook. So the same name, follow us on Facebook. Thank you for watching, and then have a nice day. Kindly observe all the social distance protocols so to avoid the spread of the pandemic, the coronavirus. Thank you. Goodbye.